Assalamu alaikum friends, welcome to lecture 26 of SBL. This lecture will be focusing on the next section, that is section F of your syllabus, which is organizational control and audit. We have just finished technology and data analytics, which is the last lecture was lecture 25, and from lecture 26 onwards we are going to the next section. The topic is management internal control systems and reporting. Why it is important to have internal control, why internal control is so important, what does a sound internal control means. See, for any business to run we need internal control. In an organization, strong internal control, without it things will not work. Your financial statements that you produce will be wrong. When the auditors come and checks your company, they cannot give a unqualified opinion if you do not have a strong internal control. So having a strong internal control is very important. Now we are going to focus on this areas, and in this lecture I have not done any question. I will not be doing any question. So you can straight away go to the revision kit and past paper and start doing questions on internal control. But the reason I'm not doing the past paper is because, as I told you, SBL is an integrated case study. You'll be having all the sections from all the areas in one case study. That's the reason I just want to first finish with SBL, all the lectures, and then I will be touching the past paper. So, but if you want, you can do revision kit questions. I'm not doing it for SBL. I myself have skipped the questions and I have managed to pass SBL with 60%. And I think that's good enough for SBL. So yeah, that's the thing. Now, in this lecture, we are going to focus on development of corporate governance, like how corporate governance will help, what corporate governance says about internal control. Second, internal control and risk management. Third, what is internal control means, definition. Then objectives of internal control, the limitations of internal control system. What does a sound control system means? We are also going to focus on roles in risk management and internal control. Whose duty is it to review the effectiveness of internal control? How the information must flow to the management? What are the characteristics of good information? And fraud risk management strategy, the last. This is more like, if you find this lecture will be a little dull in a sense of you have a lot of theories, lots of reading to do. That's what I would say. Okay, so let's start. Regarding corporate governance, okay, there were various reports that were introduced. Why? For the internal control. First report that was introduced is known as Cadbury report. Now for SBL exam, you don't have to know the details of when Cadbury report was established, but having a brief understanding of what is the main thing that is covered in this report will help you a lot. You don't have to know details of Cadbury report, Google, and know all. No, it's not needed. Okay, so starting with Cadbury report. In Cadbury report, the main thing is that is included in this report was what? Audit and accountability section. Audit and accountability. That means you should be able to disclose and you should be able to communicate with shareholders and stakeholders. Information needs to be disclosed and it needs to be communicated with shareholders and stakeholders. So this is placing emphasis on communication with shareholders and stakeholders and good communication, disclosure. Okay. The report confirmed that directors should establish a sound system of internal control and review the system on a regular basis. Cadbury report says, whose responsibility is it? It is not the auditors. Directors' responsibility that they have to establish a sound system of internal control. Now you just think, if it's your business, whose responsibility will it be to have a strong internal control in the organization? Obviously, it's your responsibility. Same way, it is the directors. And who is going to review? Just having a sound system of internal control is not enough, my dear. You need to review that annually, or you can do it more frequently, but on a regular basis you have to review that system, whether it is working or not, whether it is achieving the objective it was supposed to or not. Second report is Turnbull report, which is 1999. This says, okay, that directors have to, it is placing emphasis on the director's responsibility, that they have to review the system of internal control and they have to report to the shareholders. So it's the same like Cadbury report, but here the emphasis is more on director's responsibility. Okay, let's go in detail what it includes. It is like giving you a framework how an internal control has to be. Second, through this framework, it can help you to establish system of internal control. It's like basically it's like giving you a guidance. Okay, that these are the things which has to be there. These are the things which should not be, which should be avoided for having a sound internal control. And work done by the committee of sponsoring organization. We'll be using the short form throughout, which is SOSO or COSO. We'll say COSO in 1992, and this was referred in this report. Okay. Now, internal control and risk management. Why is it so important? See, earlier we have already covered one section on corporate governance. That was your section B. Your section B was corporate governance, right? If you can remember your previous lecture, there we have explained the detailed under corporate governance. So corporate governance also says you should have a strong internal control as well as a risk management procedure has to be there in any organization. They are fundamental concepts of good corporate governance. If these two are not there, means you are not having a good corporate governance. So because of that also you have to have internal control and risk management. Okay. Good corporate governance means what? Board is identifying and managing all the risks for a company. Okay. Then in terms of risk management, internal control systems span finance operations, compliance, and it's just not internal control in the finance. It is also in the finance, compliance, and other areas. It includes all the activities of the company. When we say internal control, does not mean only finance. No, everything. It's a broad topic, internal control. Okay. Now we are coming to the risk management. This is pretty easy. If you see, it's very easy. That's why I can quickly go through the slides. I don't much explanation is not needed. That is the best thing about this section. UK Corporate Governance Code recommends board should maintain sound risk management and internal control system. Who says it? It is the UK Corporate Governance Code that says that you should. That's why we are studying this risk management and internal control. Cadbury reports said that risk management should be systematic. Risk management, when you are having in an organization, it should not be done in a haphazard way. There should be a system, and it should be embedded in the company's procedure. It's not that for some risk you will be having risk management, some risk you will ignore. It's not like that. It should be embedded in your company's procedure. It's like you should have that culture of risk awareness. Everyone should be aware of the risk. There should be a culture. Now we are coming to internal control and COSO. COSO, see, I'm giving a little background. What is this COSO? Little background for you to understand it better. But you don't have to understand, you don't need this knowledge in your exam. It is just basically what COSO does and how it is related to internal control. What is the relationship between COSO and internal control? That's why I'm giving a little background, just for your understanding. Not important, not relevant for your SBL exam. COSO was formed in 1985 to sponsor the National Commission on Fraudulent Reporting. They are like setting a forum, you can say, so that fraudulent reporting does not take place. That was the main aim of COSO in 1985. The sponsoring organizations included what? American Accounting Association and the American Institute of Certified Public Accountants. It includes other organizations also. It's not just one organization. COSO includes group of organizations. So now COSO provides guidance on the implementation of internal control systems in large and small companies. That's why. Now do you understand why we are studying COSO? Because they provide guidance on how you can implement internal control, not just in small, but also in large companies. Now, there are three aspects. Okay, internal control is applied in three aspects of the business. What are they? Number one, effectiveness and efficiency of operation. This three you should know. Effectiveness and efficiency of operation. That means internal control should help you to achieve your business objectives. Second is reliability of financial reporting. It should make your financial reporting more reliable. It should help you in the preparation of financial statements. Third, compliance with laws and regulations. So internal control should help you to achieve your business objective. Second, it should make you it should help you in preparation of financial reporting. Third, you should be able to comply with laws and regulations. So in these three areas, internal control is applied. These three areas you should know, by the way. Now, internal control and Turnbull report. Turnbull Committee was established after the publication of 1998 Combined Code in UK. Later, it became UK Corporate Governance Code. Okay, you don't have to know the history and detail all those things. So basically, what do? They provide guidance for the advice for the listed companies on how they can implement the internal control. Overriding requirement of their report was that director should. There was an overriding requirement. What was it? The director should implement a sound system of internal control and they should be checked on a regular basis. These two are the important things. Director should implement, director should check also. Now, internal control deficiencies. What is the meaning of control? See, control means anything that you are doing, any activity to reduce a risk. Why? Because this risk will not let you achieve your business objective. In order that you minimize the impact of the risk, you should have a stronger control. Correct? That's the reason. Internal control system is like it's like a group, it's like a network of system. That means from top to bottom in an organization, there's a system. And why is it so? So that it provides a reasonable assurance that objectives are achieved. Reasonable. Look at the word I'm using, reasonable, not absolute. It cannot give you 100% guarantee. Even if you have a strongest internal control system in an organization, still things will go wrong. We'll later see the limitations. Then internal management control. This is regarding the procedures and places to ensure that objectives are achieved. And then the control procedures and policies provide the detailed controls. If you're having some procedures, what are they? Detailed controls. We'll go through this later, a little bit later. Now, objectives of internal control. This, from your exam point of view, is very important. Objectives. You can be asked this, not directly, but as a case study. Maybe they will give you a question where internal control is failing or weak internal control, or they might have a strong internal control, whatever it is. You should know the objectives. An internal control system is to ensure, as far as practicable, okay, it cannot give you 100% guarantee. No system can give you 100% guarantee, but fraud will not happen, error will not happen. It's impossible. But however much possible, their job is to ensure this few things. Number one, it should help your business to be conducted efficiently and in an orderly manner. That means the way your business functions becomes very smooth when you have a strong internal control. Second, safeguarding of assets. Assets is very important for any business. You need to safeguard those assets. So internal control system will help you to ensure that. Third, prevention and detection of fraud and error. Sometimes it prevents. Fraud does not happen. Before the fraud happens, you get warnings or things like that. So you prevent. Detection means already fraud has taken place, but you are able to detect it. And now you're trying to correct it. That is the difference between prevention and detection. It could be fraud or it could be error. Accuracy and completeness. Your accounting record becomes more complete and more accurate. Timely preparation. You can timely prepare your financial information. You can comply with laws and regulations. Okay, that's a benefit. Okay, so now we'll go through the benefits of internal control. There are 3 benefits. Number 1, these are the same things where your internal control applies. Effectiveness and efficiency of operation, reliability of financial reporting, and compliance with applicable laws and regulations. The 3 benefits. Know the benefits and objectives. Now we are moving to the limitations. This also, from your exams point of view, you must know. Number 1. Sometimes what happens is, what I have seen personally in the case study, most of the time they give you an organization's example where internal controls are weak, failing. You should be able to identify what are those weaknesses. And then you have to try to recommend them how to overcome them. Most of the time this is a question. Okay, so that's why you should know the limitations as well as the objectives, the benefits. Number one limitation is, okay, you are having a strong internal control, but what about the information that is given there in the system? What if the information is not adequate information, or it is handled by some inexperienced staff? Then the decision making that you are making is will be poor. Okay. Second, human error. Internal control system will be handled by humans only. Even they can make an error, no matter how well designed the system is. So up to a certain extent, you cannot reduce the risk. Third, control process. Sometimes what happens, employees or even the senior manager, they might deliberately, what do I say, cir- circumvent the control process. They might feel it's not relevant for them. It's not important. Why should they go through that? Management overriding control. Same thing. Management also might do. They override controls, believing that it's not convenient or inappropriate for them. So it should not apply to them. Control systems are designed to cope with some certain range of variables. If this happens, this is how system will operate. But what if certain thing happens which is outside that scope, outside that range? System will not be able to cope with it, unable to cope. Now, these are the three features of sound internal control system. You say an internal control is sound when these three features are there. It should have these three features. Number one, it should be embedded within the operation. It is not a separate exercise. It is not a voluntary thing that if you want, you take care, you look after the internal control, otherwise no. It should be embedded within the operation. If it is there in your operation, it's a sound internal control system. Second is, that system should be able to respond to the risk within and outside the company. Third, it should include procedures for reporting control failings or weaknesses. If your control is not operating effectively, if it's failing, there are some weaknesses, procedure should be there to report that weaknesses. Then only you can say you have a sound internal control system. These three things. Remember these three features as well. Objectives, the benefits, the limitations, and the features of sound internal control system. These are the four main areas. Now we are moving on to the roles in risk management and internal control. Who has what roles? It is the executive management's roles for internal control. Okay, but it is not simply only their responsibility. Sole responsibility lies with the management, but not only their responsibility. Other people are also there, like employees. Some employees, or I must say all employees, have some responsibility for monitoring and maintaining that internal control, because internal control is an integrated thing from the top to bottom. Everyone should look after that, everyone should monitor, everyone should maintain that. Okay, so it is just not the executive management in the top level is looking after, and employees are being very careless, not even looking after. No, they also should monitor. So it is, so the way they monitor could vary. CEO, who is setting the tone for internal control from the bottom, and the manager who are carrying forward and looking after, they're implementing it, they're monitoring, actually monitoring. Okay, so it is the CEO who sets the tone for internal control compliance, and the external auditor who then later reports that effectiveness of the system. They come and check whether the system is effective or not. If it is, they will report it by report in the report. The Turnbull report addresses the responsibilities of directors and management in relation to risk and control. We'll see what the report says. Responsibilities also you have to know, by the way, because what happens in your case study, if they give you that certain people are not following, like they have a weak internal control, then whose responsibility is it? You should know this. Number one, directors. Directors should set appropriate internal control policies. Second, seek regular assurance also whether the system is functioning or not. Third, review that effectiveness also. Provide disclosure on internal control in annual report and accounts. After review, you have to report it also. There is no use of just just reviewing if you are not disclosing it to anyone else. Directors should review internal control. When you are reviewing internal control, how do you know whether it's good or not bad? How do you say good or bad? Whenever you judge something, you should judge it against some benchmark has to be there, no? Against something you have to uh, what do I say? Judge. So what is it? Again, what? COSO says that they should review under 5 headings. This heading is given by COSO only when you're reviewing internal control. What is it? Number 1, control environment. Number 2, risk assessment. Number 3, information system. Number 4, control procedure. And number 5, monitoring. Remember this 5. First of all, control environment. What is your environment? We'll go in detail in each of this 5. But this 5 list you should know. Reviewing internal control means your control environment should be good enough, should have a strong control environment. Risk assessment has to be there. Information system has to be updated and has to be passed on. Control procedure has to be there and monitoring has to be done. If all these 5 things are there, you can say you have a strong internal control. If anything lacks in any of these 5, you can say you need to work on those. So having these 5 headings will tell you where you need to work on. Is it in the monitoring you have to work on? Is it the control environment itself is wrong? First you need to set up. So you have to see these things. Next, it is the management. Management's duty is they should implement the board policies. Directors, they set the policies. Managers, they implement that policy. And they identify and evaluate the risk that is faced by the company. Now, reviewing the effectiveness of internal control. This is normally the responsibility of the management. Okay, but remember, this can be done by the audit committee also. Reviewing the effectiveness will be done by the audit committee. Maybe the manager has delegated it to the audit committee. Maybe the board does not have the time to do that, so they might give it to the audit committee. It's possible there. The board must provide information on the internal control system and review the annual accounts. Yes, it is just not reviewing, but you have to give that information in the annual account. Review should be carried out at least annually. At least. Okay, minimum. Maximum, there is no limit. You can do 4 times, 5 times review, it's so good. But once a year, review has to be done. Why is it so? Because by the time your controls is, let's say this year you have done a review of your internal control system. By the next year, risk of your company might have changed. Your company might have changed, staff might have left, control system. So you should see whether that same internal control system that you have checked this year, will it be efficient next year also or not? That's why you need to review. It might not be. Same control system, okay, cannot operate for 3-4 years. You need to always update internal control system. It's just not that once you set and it's there. No, you always need to update, always need to improve, always need to make changes to your internal control system. How will you make changes to internal control system? Through reviewing. You first have to review. If you do not review, you will not know what are the weaknesses in your internal control system. From time to time, you have to update. So they identify 5 elements of effective control system. Number 1 is control environment. Now let's see what is control environment is. The word environment says that your environment has to be right. That means I have highlighted it in bold that this is sometimes referred to as the tone at the top of the organization. This is often the first element that you will look for. Forget about your controls procedure. Forget about monitoring. Monitoring will not come into the picture. That is the last step. First is your control environment that you need to set right. That means people in the top of the organization. What is the management's philosophy? What is the ethics? What is the culture of the organization? All this will matter a lot in your control system. What is the commitment of the board of the directors? What is the authority? How the staff are organized? How they are developed? You have to see all those things. How the leaders are behaving. Because it is their responsibility. If they set the right tone from the top, then people in the bottom are anyway going to listen to it. Things at the bottom will work out on its own. But at the top, things needs to be set fine first. Then, control environment includes the following element. These are the elements. Management's philosophy and operating style, how they operate. What is the organization structure? What is the assignment of authority and responsibility? Human resource policy and practices. Competence of the personnel. What is their skills, expertise? Second is risk assessment. All these 5 that I'm going through, details, you should know it from your exams point of view. Risk assessment. Risk assessment is divided into two factors. One is internal, one is external factor. Internal factor, like your staff turnover level, if it increases, quality of your staff, how complex is your organization, if there is any organization changes, these are internal because inside the organization is taking place. You can have a control over it. Next is external factor, beyond your control. Industry changes, economic changes, technology, new technology comes. So because of this, new risk also will come, no? Next, we have risk assessment process should also distinguish between two things. Risk which you cannot control, risk which you can control. Controllable risk. For controllable risk, it is up to the management whether you accept the risk or you take some measure to reduce the risk. Risks which are not controllable. Can you do something? Can you reduce the risk? Is it worth it? You can't do anything. So you either accept the risk or either completely or partially avoid the risk by not going into that business activity. Third, we have control activity. Control activities are like it occurs in any organization. It's like the policies and procedures that is there in any organization. Like authorizations, who will authorize, who has the authorization power to sign checks, how do you verify, reconciliation, approvals, who give the approvals, segregation of duties, how your duties are segregated, performance review, asset security measure, all this are control activities. Okay, they are also referred to as internal control. Most of the time, it is the control environment on this area questions has been tested compared to the other five elements, control and activity, the third activity. Then the fourth is information and communication. Okay, because just having internal control, you are having activity also is not enough. Any manager, any director to make a decision, they need information and it needs to be communicated to them. If it's not, how can they make decision? That's why they have to get information and it should be communicated to the right people. Managers need both internal and external information. Then the fifth is monitoring. All this whole system needs to be monitored, needs to be reviewed, and it has to be done frequently. Okay, and who does it? Management again. They only establish first the control procedure, the environment, the risk assessment, and they only monitor. All these five steps are done by whom? The management only. So it is their job to monitor the internal control system. It is their job to identify any deficiencies. It is their job to report this to the senior management or the board of directors. If they find any deficiencies are there, report it. Don't sit with that deficiency. Things needs to be done. The board can delegate this duties, some of these duties to the audit committee also. Okay, the monitoring part only. The other four steps, elements needs to be done by the management only. That you cannot delegate to anyone else. Now, let us go through the, as I told you, control activities, the third element. It has list of activities. What is it? And this, you should know it. Better you know it. Okay? Questions will be asked on this. If you see, before I read each of this, just read the letter in bold. SPAMSOAP. You can make an acronym out of this. What is it? Just read it. Spam soap. If you want to recall, if you want to remember it, you can remember it like spam soap. Right? It will tell you. So S stands for segregation of duty. That means no two people should have, no one people should have do two jobs. And this is very well said in your corporate governance code also. Remember, the CEO and the chairman should not be the same person. Because if one person is having too much of power, he can misuse it. He will misuse it. It's a human nature. They might not have the expertise to do both the jobs perfectly. So segregate the duty. We have examples on this also. On each of this, I'll be explaining you the examples with examples. Don't worry. Physical. How do you take care of the people? How do you recruit them? You need to train them. Then we have authorization and approval. Some things are very material. For example, material transactions has taken place. Or if you are giving a big amount of checks to someone, this needs to be authorized and approval has to be given. Management. Okay, then we have supervision. Who supervises? How it is supervised? Organization. Then we have arithmetic and accounting, because finance is important, whether it is correct. Then we have personnel. Okay, so let's go in detail, starting with segregation of duty. Example is, let's say in the purchase. Okay, same individual should not have responsibility for making a purchase and making the payment also. Making the payment, recording the purchase, and payment in the accounts. One makes the purchase, the other one records that purchase. It should not be done by the same people. But remember, even if you have segregation of duty, it does not mean that fraud will not happen. Because segregating duties will provide protection against fraud by one individual. You can always check one individual. Suppose you think that giving one individual too much of power will make him to cause fraud, so better give it to two people. In that way, yes. But what if the two people join together and plan to make the fraud? If two or more individuals get along to commit a fraud, it's very difficult. Segregation of duty will not work there. Why I'm telling you this is, in your exam also, when you are giving them a correct internal control activity, sometimes you have to suggest which out of this SAM soap, out of this 8, which one is more appropriate. Segregation of duty will not work if two people are, they're joined, they're planning to commit a fraud. So in that case, if you are making a purchase and telling the other one to make the payment, two people, they still can make mistakes, they still can do fraud, and you will not know also. It will be not identified or detected also. So it will not always work. There are always disadvantages of all these methods. Second is physical control. Physically, it will check your asset. It will take care of your asset so that it is protected against any theft or unauthorized access. Like it can include using a safe to hold cash. You can put your cash in the safe, or any valuable documents, or you can have a secure entry system. You can have dual custody of valuable assets. Two people are looking after that. Then check your inventories often, and have CCTV camera, security cars, make them, you hire them. All these are physical controls. Okay. Then we have authorization and approval. This is usually for the transaction. That means a transaction cannot go ahead if it's not being authorized by an appropriate individual. And that authorization could be given in any way, verbally or most probably in writing. Okay. Let's say for spending transactions, there is some limit. That means this is the authorization limit. Beyond this, you cannot spend. Then we have management control. There are two types of control in management. One is top level review. That means the board of director or senior management, they might call for a performance report. Why? They want to check the progress of the organization. Okay. For example, the senior management, they might review a report on the progress of the organization. So questions should be asked by senior management. Now management is going to ask, the senior management is going to ask questions like what? From that, after they have reviewed the report. That means they are expecting a response from lower management level. So in this way, the top level reviews are a control activity. Through this, you can have a check over what the lower management levels are doing correctly or not by having a top level review. Second is activity control. You control their activity. This is done at a lower level, like at departmental or divisional level. Like management should receive reports. How are they controlling? By having the report. Okay. And functional review should be more frequent than top level review. See, top level review does not happen daily. Activity controls needs to be done daily, more frequently. Okay. Because top level reviews are done once or twice, and if it's done, that time they ask questions from the lower level manager. Okay. An example of control by management. How do they do this? For example, they might be asked to give a regular performance review report, like variance report, to check where they can compare the actual with the budget. This is like it's not a top level review, it's an activity control because it is done more frequently. Supervision. Supervision is an oversight of the work of other individuals. That means you check the work of others by someone in a position of responsibility. You are at some top level yourself and you are overseeing the work of the other individuals. Supervision cannot be done by anyone. Okay, you yourself need to be at some position of responsibility to overview or to supervise the work of someone else. So through this, through supervisor, you can make sure that individuals are doing the task or not. Imagine if no one is supervising that individual, he will do whatever he wants. That's why in the exam and all we have invigilators and all, right? Why? Because simply to supervise us so that we don't cheat. Organization. Here, they separate the organization's activities into departments or responsibility centers, like where each divisions are told that they have this responsibilities. Clear division of responsibilities are there. Delegating authority within the organization. Okay, you delegate. Established reporting lines has to be there. Reporting lines has to be there. This person is to report that person. But through this, you are creating some type of some form of control. Coordinate the activities of different departments by setting some committees or project teams. Because if you are accountable to someone, your project team leader or your leader or your functional head, okay, you will be prone to do things more better in a more ideal way, right? That's like a control you are having over them. Arithmetic and accounting, this is easier. You are recording transactions properly. You are able to trace that individual transaction through accounting records, and you are checking the arithmetical calculations also whether it is correct or not, right? Double checking the figure in an invoice before sending it to the customer, or approving it for the payment to make sure that they are correct. So these are some arithmetical controls. Personal control. Here you give them induction and training to the employees that you are going to hire, so that they can work with the system better. You are making sure that whoever you're hiring, they should have the qualities, the experiences and the qualifications that are required. Otherwise they will not be able to do their task efficiently and effectively. Through this you're controlling the personnel, and you can give them training regarding the controls, how they have to operate the control system, okay, whom they need to speak with if things go wrong. They should know all this thing. Training has to be given to this stuff, okay. Now, information flows for management. We are coming to the information side, the fourth element, if you remember, information and communication. So, to enable management to identify and manage risk and monitor internal control, they need information. If you are telling someone, this is the risk, you need to manage it, you need to monitor. How are you going to do that? You need information in your hand, first of all. Okay. So, they need adequate information flow within the business. This thing has to be there. Effective channels of communication should always be open in an organization, so timely information is received. Second, information should be provided regularly to the management, not just one or two times, so that they can monitor the performance. Managers need both internal and external information. And actual information that you are giving to the management, this varies depending on the different levels of management. Some needs more information, some needs less information, some needs detailed information, some needs summary. Different information systems are available to provide the required information. Make sure that when you are giving information, not just one type of information is there. There should be qualitative information as well as quantitative information, verbal information as well as written information. Now we are dividing this information according to the level. There are three levels, as you know. One is strategic, one is tactical, one is operational level. According to that, the way your information will be different. Starting with the strategic, that is the top level, board of directors. What type of information do they need? Information that they need are very difficult to predict than the other levels of management. It's not very clear. Second, this is they are placing greater reliance on informal. This type of information is more informal and it is often an ad hoc information system. They just get the summary information only. EIS should provide this range of info. What is EIS? Executive Information System. This is only for the strategic level. They provide this range of information. Coming to the tactical, this is the divisional management level, lower than strategic. This they get this type of information from transaction processing system, although it might come from external sources also. DSS, what is it? Decision support system. DSS stands for decision support system. Okay, they will project current trends into the future. That means whatever the current trend, through that you can decide your future. Decision support, they will support your decision in the future. So you look at your current trend and accordingly project that in the future and say that this is how it's going to react. But while the MIS will concentrate on exception reporting on current information. What is MIS? Management Information System. This is for the tactical level. They work on the current information. Then the last is operational, junior management level. This operational decisions are programmable. Okay, you can program them. They require specific and very detailed information. You can even program their decisions also in the computer. It's easy because you have detailed information. And it comes from the simplest form. TPS, that is transaction processing system. And the output from the systems are reports, simply reports and sorted list of transactions. Now, coming to the qualities of the information. What makes a good information? Very important. This is, I think it is there in other subjects also, other papers also, not just in SBL. And if you read just the bold letter, ACCURATE, it stands for accurate. So whenever you want to remember the criteria of good information, remember the acronym of it, accurate. The short form, accurate, which stands for accurate. The first A itself stands for accurate. Coincidentally, I mean both are accurate, but don't get confused with this accurate and this accurate. There are two accurates. Accurate. Information needs to be accurate. Otherwise, what's the point? Second, needs to be complete. Third, cost beneficial. The benefit of the information should be more than the cost of giving that information. User targeted. It should be targeted exactly at the user that you're pointing. For example, the information that you're giving to the shareholder will be different to the information you're giving to the banks. Totally different. Or to the employees accordingly. Otherwise, information that you are giving for the shareholder, if you are giving the same information to the bank or your employees, it will be of no use. It will not be relevant for them. It's not user targeted. Make sure the information is user targeted. Then relevant. Information should be relevant. It should be authoritative. Okay. It should be timely. It should not be that you are giving the information after 2 days or after 10 days, after a week. Easy to use. Information should be very user friendly. Should be easy to use. You should avoid technical jargons which the normal users will not understand. Next, let's go through this table. This will tell you the differences between the strategic and operational. Let's start with the characteristics. Time period. If you are looking at the time period, for strategic is focused. Why? Because they have to make decisions for the 5 years, 10 years from now in the future. They want focused, predicted. For operational, they will make their decision based on historical financial statements. Timeliness, for strategic it is delayed. And for operational, immediately available. Why? Operational, they have vast amount of data. Easily they can just take it from the system. Strategic, no. It's delayed. Objectivity, that's why objectivity is subjective for strategic and objective for operational, because they have data. Strategy, they do not have the data, so it's subjective for them. Quantifiable, even terms of quantifiability, strategic decisions are qualitative, information are qualitative, operational are quantitative. Accuracy, for strategic is not so very accurate, it's just an approximate. Operational is very accurate. Certainty, for strategic is uncertain, operational certain. Because longer the time period, it becomes more uncertain. We all know that. Completeness, not very complete for strategic, partial. Operational, it's complete. Breadth, very broad for strategic, but for operational, it's very specific and detailed. For strategic, it is often summary. When strategic leaders have to make decision, they go by the summary. They will not go through all the details and everything. So less detail, and for operational, it's highly detailed. Okay. Now, coming to the last of part of this lecture, fraud risk management strategy. It includes three key elements. Number one, fraud prevention. where you prevent the fraud from happening itself. Second, detection. Fraud has taken place, now you detect. Third is fraud response. How do you respond to that fraud? These are the three elements. So come into the fraud prevention. How do you prevent a fraud? See, fraud does not happen every now and then. It happens once in a while, but the impact of it is very massive. That's why you need to prevent this fraud from happening. How do you do that? Fraud cannot take place in an environment where controls are very tight, where no opportunity is there, no temptations are there for a fraud to happen. So what you can do is you reduce that opportunity where fraud can take place, or remove the temptation which will make an individual to commit fraud. What are the prevention techniques? Like you can introduce policies, some procedures, some control. You can give training about fraud awareness. So these are some techniques. Does not guarantee 100% fraud will be prevented. No, but something is better than nothing. Okay. Some specific examples of fraud prevention, like anti-fraud culture. Maybe in your organization, you can have a culture where it says you are not going to accept fraud at all. It's an anti-fraud culture. Risk awareness. The more you become aware of risk, the less likely you are to commit a fraud. Whistleblowing. If it happens, people are going to complain. There should be a system in place. Communication channels has to be open. Okay. And sound internal control system will help to prevent the fraud. Next is detection. Obviously, fraud prevention is the best. But what if it takes place? Then you detect. System should be able to detect it. Here, before that, a common misbelief is that external auditors are the one who has to find a fraud. No, it's not them. It is rarely the case. In fact, their letters of engagement typically state that it is not their responsibility to look for fraud. If you read the engagement letter of the auditor, they clearly tell it's not their responsibility to find for the fraud. But they still find fraud. Why? Because it is discovered accidentally based on the information that they receive. But it's not their responsibility. Some methods of discovering fraud. How do you discover fraud? Like you do regular check. For example, regularly you check the stock or you count the cash. There are warning signals in place which says that fraud has taken place, or maybe it indicates that fraud might have taken place, like failures in internal control procedure. Immediately you will become more aware that fraud will likely to take place because internal control is failing. Second, lack of information. If information is not being given to the auditors, again it's a warning signal something is not correct. Unusual behavior by individual staff member. Accounting difficulties. So these are some, if you see, all these things are not very objective. Sometimes you have to see the people's behavior, the way they deal with you, their body language. These things you need a lot of judgment. That's why auditors' job, and even the people who work in the fraud department or the crime bureau, it's very difficult. It's just not the technical area they need to be an expertise of, but also they need to know a lot about the human behavior, the body language, those things. That was very difficult. Then whistleblowers. Next, we have fraud response. How do you respond? You set out a plan that if this happens, this is how you're going to deal. It is called as fraud response plan. Okay? It provides procedures for evidence gathering. If you have a plan, it says that there is a procedure where you are gathering evidence that a fraud has taken place. You just cannot say a fraud has taken place without any evidence. You first need to have a procedure which gathers those evidence, and then you're going to take a decision based on that. Because it might be sometimes give rise to a legal action also. You have to be prepared for this. So if you have a fraud response plan, it will restrict your damage and minimize the losses to the organization and also to your reputation. So think about it. Now, fraud response might include these things. You can take internal disciplinary action according to the policies that you have set. Or you might go for an civil litigation, legal case to recover the loss due to the fraud, or criminal prosecution through the police. Now, within the response plan responsibility should be allocated to whom? Manager. See, these are some people who are responsible in that responsible end. One is manager. They are taking the responsibility for detecting the fraud in their area. Second is the finance director. They have an overall responsibility for the operational response to the fraud. Sometimes they might delegate this role to whom? Fraud officer or internal security officer. Third is human resource department. Any disciplinary action that is to be taken is done by HR department. Audit committee. They review the details of all fraud and they receive the report of any significant event. Internal auditor. They investigate for the fraud. It is their task. External auditor to obtain expertise. If internal auditors need any help, they take the help from the external auditor because they have the expertise. Legal advisor also you can take help for any disciplinary action or civil or criminal responses. Public relation. If the fraud is so large that you have to make it a point that it comes to the public attention, you have to do it. Police, where it is a policy to prosecute all those suspected at fraud. You prosecute all those who are suspected of fraud. You call the police. Insurers, where there's likely to be a claim. You have to be in touch with the insurance because sometimes you have to claim. So that's it for this lecture. Now we are going to go summarize everything that we have discussed. This is a very easy lecture, very easy lecture. And most of the time, from my experience, I have seen that students often score well in this part of the lecture, this part of the syllabus. In the exam, if it's asked, identify the weak internal control, then recommend what should be done. Most of the students are able to do fairly well enough in this part. So we started with internal control system, saying it's a whole network of system, okay, which gives a reasonable assurance, not a guarantee 100%, no, reasonable assurance that objectives will be achieved. Second, responsibilities of internal control and risk management. It is the fundamental concepts of corporate governance also. Objectives of internal control: orderly and efficient conduct of business, safeguarding assets, prevention and detection of fraud, accuracy and completeness of accounting records, and timely preparation of financial information. Fourth, we went through limitations. Limitations are risk will be minimized but never entirely eliminated. Sound control system. It has to be embedded within the organization, capable of responding to risk, to quickly to evolving risk, not just the risk that stays the same static risk, no, evolving risk. Suddenly new risk comes. Control system is that which will be able to respond to it quickly. Procedures for reporting control failings. Roles: board of directors and the executive management. It is their roles to look after to review the internal control. Seventh, review the effectiveness. Responsibility of the management. Course of 5 elements. You must know this: control environment, risk assessment, control activities, information and communication, and monitoring. Control environment, we told, is like the setting the tone at the top level, the culture, the management's philosophy. Risk assessment, you go through the risk, controllable, non-controllable. Control activities is that spam soap, segregation of duty, personal control, that thing, right? Information and communication, characteristics of good information, and you have to communicate. Monitoring could be done by the audit committee also. Then management information flow, we told, through information flow they can perform tasks, they can monitor performance, they can make informed decisions. Characteristics of information: accurate, means A stands for what? Accurate. C stands for cost benefit. Another C stands for what is it? So you should know all this. Accurate. Okay, go back and check if you forgot. So that's it for this lecture. Thank you for watching and see you in the next lecture. And if you haven't subscribed to my channel, don't forget to subscribe to my channel. Till then, thank you for watching and see you in the next lecture.